Hi, Larry Berman here, and here's what's on my radar this week. Well, as we look into next week's calendar, the FOMC meeting and the potential for them to accelerate the taper, that seems to have been widely telegraphed already by Powell in recent statements. So the market shouldn't be too surprised if the Fed actually does that, and for the most part is holding in relatively well, including long bond yields having rallied and having got through this past week's big supply. The 30-year auction didn't go well at all. But again, even post-auction, bond markets hanging in okay in terms of yields, with the 10-year still around 150 or just south thereof, and the 30-year still well under 2%. You know, the 175 plus on the 10-year, 2.25 plus on the 30-year, that's when we really start to get concerned that bond yields are going to have an impact, start to have more of an impact on equity market valuations. And so we think that's coming. Tapering is part of that. The faster they get towards removing accommodation and getting a bit tighter, but make no mistake, everything's still very, very easy. Financial conditions still very, very easy. But when you think about what that 1.4 trillion in spending means, and they don't do it again, and the government's running $1 trillion deficit, that supply pressure should impact bond yields. To the extent that there's a demand for treasuries because yields all around the world are lower, or there's a risk-off event, the US bond market still has that benefit largely. So for us, that's next week, and market should get relatively quiet. But if the Fed does throw a curveball and surprises the market, we could see some more volatility into year end. At this point, when we study what the strategists and analysts are saying about 2022, the spread for the S&P 500, 5,200, 5,300 kind of high end from where we are now, around 4,700, with 43, 4,400 at the low end. That spread from high to low is the biggest in a decade since the great financial crisis. So strategists have very, very different views on the correct valuations for the market. Then it matters on earnings. Can companies still deliver on earnings? So as we get into January, yet another quarterly chapter of that book opens, and it's generally been very, very good. So, you know, eyes focused on that for the new year to see how it begins. But for now, the market seems to be okay. The recent backup that we saw over COVID seems to be past us. We'll learn more also this coming week on output from South Africa. It seems like Delta is picking up in some places. COVID's the new variant. Omicron is spreading. So we'll see how that plays out. But it looks like the vaccines and boosters are going to help, and really we're not going to see stress and increased death levels. So hopefully markets will be okay with that. But from a technical perspective, the lows that we saw on the recent pullback around 4,500 now become key, because if we take those out, that 200-day average, which is around 4,300, just below that, and the September lows becomes a really high probability target. I still think we see that at some point in Q1. When that is the harder question. So as we get into tax loss selling season, there's a lot of opportunity out there for the bull picks. I still like Chinese internet names. I listened to a couple webinars this week with specialists in China, geopolitical strategists. The overwhelming view that I see is that China needs the world more than the world needs China in terms of them growing and becoming bigger. But inequality there is a big issue too. And make no mistake, the rhetoric coming out of there, as they go into the October 2022 next 5-year plenum, which is their big year planning. Xi's would be third anniversary of him being nominated president, which seems very likely at this point. So that rhetoric may continue until we get a lot closer. Turns out that's a month before the US midterm elections. So 2020 has a lot of bells and whistles too, but the value in China compared to the value in large cap tech and other places in the world, and the US in particular, seems very, very compelling. And I would look at some of those names in terms of where you want to look for some value. And to the extent that bond yields are going to push up, it's still large cap tech that we're most concerned about. And in particular, not the Apples of the world per se, although they're highly overvalued. It's more of the companies that don't have stable earnings that when interest rates get pushed up a little bit would get hurt the hardest. That's where we've seen a lot of the weakness so far this year. And I would expect as interest rates rise into middle of next year, we'll see more of that. And so, bias towards avoiding those areas. Have a great week, everyone.